Dear audience, my name is Gabriel Acuña. I am the head of Sustainable Finance Information Oversight and the co-coordinator of the Climate Change Working Group of the Financial Market Commission of Chile. And it is my great pleasure to welcome you to the first climate-related financial risk conference of the Financial Market Commission of Chile. We have organized this event with invaluable support of the Inter-American Development Bank, the Central Banks and Financial Supervisors Network for Greening the Financial System, NGFS, and the British Embassy in Chile. We are now in our second and last day, and just like yesterday, today's panels will be held in English. However, there is a simultaneous translation option available to you by changing the language option at the bottom. We start this day with an extraordinary panel titled Institutional and Financial Markets Challenges of Climate-Related Risks, with two great international experts on the topic. Moderating this panel and chairing it, we will have Commissioner Dr. Bernardita Piedrabuena. Dr. Piedrabuena holds a PhD in economics from the University of Chile, a master's degree in economics from the Catholic University of Chile, and a commercial engineering degree from the same university. She has been capital markets, international finance, and macroeconomic area coordinator of the Ministry of Finance of Chile, and a member of the Fiscal Advisory Council. She has been a senior advisor to both the Ministry of Economy and the Senate of the Republic of Chile. Before joining the Financial Market Commission, Dr. Piedrabuena worked as a corporate risk manager at the Central Bank of Chile and has been a consultant for different companies. Dr. Piedrabuena, the floor is yours.
Thank you very much, Gabriel, for your presentation. For me, it's an honor to be here, to be chair of this panel. Today, we have the privilege to moderate, the privilege to have two experts on financial climate risk, Dr. Fischer and Dr. Patalano. Dr. Fischer chairs the London Bullion Market Association. He's a non-executive director at the UK Debt Management Office. He provides consultancy services to central banks and spends about half of his time on academic work, including climate change. He's also a visiting professor at the London Institute of Banking and Finance at Richmond, the American International University in London. In 2007 and 2018, he participated as a member of high-level expert groups on sustainable finance at the European Commission and the UK Green Finance Task Force, and worked for 26 years in the Bank of England, where, among several senior positions, he was a member of the Monetary Policy Committee and the deputy head of the Prudential Regulation Authority. Dr. Robert Patalano is the deputy head of the division at the OECD Committee on Financial Markets. Among his functions are direct the assessment of sustainable finance concerning ESG rating, performance and investing global market analysis, digitalization of finance, and the data analysis and reporting initiative of the Institute of International Finance. Voluntary Principle for Debt Transparency. Dr. Patalano represents the OECD in a number of working groups at organizations such as the Financial Stability Board, the NGFS, and the European Securities and Markets Authority on topics like financial stability, sustainable finance, and digitalization of finance. Dr. Patalano also serves as the OECD's representative on the G20 Sustainable Finance Working Group and the NGFS Market Transparency Workstream co-chair. We are honored to have such a distinguished guest with us today. We will start with Dr. Fischer's presentation, and then we will listen to Dr. Patalano's. Paul, the floor is yours.
Thank you very much, Bernardita. And let me just, great pleasure for me to be invited to present to you today. I'm just going to share my slides with you now. As Bernardita said, I was a long-term economist at the Bank of England, and I got into climate change when I was deputy head of the Prudential Regulatory Authority. So I now spend a lot of time thinking about financial regulation and climate change. And this short presentation is just going to try and connect up some of the risks and responsibilities for financial regulators. This is the agenda. A quick look at what the risks are to the financial sector, and then look at the role of financial regulators and central banks, because this is still the biggest stumbling block, is people trying to rationalize why it is that financial regulators are involved in this space. I want to see if I can give you some convincing reasons. And then we can get into how financial regulations can reflect climate change, which is still a very much an emerging topic. So I was an econometrician by origination, so I always start by looking at the data. And in this case, we start with the amount of carbon dioxide in the atmosphere. And this chart is interesting. It goes back 800,000 years, with the data source being core samples taken from the Arctic ice sheet in Antarctic. And what you can see is that the level of carbon dioxide in the atmosphere now is already 80% higher than what should be normal. And by the time we get to net zero, even if we succeed by 2050, that's going to be about double what it should be. And the point of this chart is just to say that net zero is not the long-term ambition, it's a short-term ambition. If we really want to be sure that the climate of the planet is stable, I suspect we're going to have to get carbon dioxide back to where it ought to be, which means many, many years of negative contributions to greenhouse gas emissions, which means we need to develop technology to take carbon out of the atmosphere. And I say that because people are sometimes fussing about whether or not they can still contribute to climate emissions or not. Clearly, we need to shift this debate to one where we have to do everything we can to take carbon dioxide out of the atmosphere if we want to make sure that we have a stable climate. And then we look at the global warming data. And this chart from UK's Meteorological Office uses several data sets just to show some of the measurement variation in the different seasons. But we're already at about plus 1.2 degrees. And these numbers, when we talk about global warming, a lot of people talk about plus 1.5, plus 2, without saying what it's relevant to. And if you read the Paris Agreement, it's the average temperature between 1850 and 1900, which is taken as pre-industrial, which it is for most countries. It doesn't happen to be for the UK, but it is pre-industrial for most countries. And at first glance, this chart appears to show a trend back to 1900. But I think that's a bit misleading. If you put on a couple of reference lines, what you can really see is that global warming started to accelerate around about 1970 or so, and has been on a very sharp upward trend since then. And this is not a coincidence, because this is when the Asian tiger economies started to really grow and add their climate emissions to those that were taking place in North America and Europe. And now North America and Europe are actually on declining trends, and the largest emitters currently are places like India and China, although of course in the case of China, a lot of that is for export to Western countries. So we still have the blame, if you like, even if the origin has shifted. So this trend is not linear, it's been accelerating. The other to take from this graph is the volatility of the temperature year to year globally. And if one breaks it down into smaller geographic regions or smaller time periods, it gets even more volatile. And so we have a nonlinear trend with extreme volatility, and the financial risks relate to that, because the financial risks that are likely to get firms, particularly financial firms, is the short run climate shocks, whether from policy or physical risk we'll come on to. It's the volatility which is likely to get people first before the trend does. The trend is very important. It means things get worse and worse over a long period of time. But it's the volatility I want to stress in terms of the financial risks and the difficulty of predicting this trend. A lot of financial risk management is based on past data sets, but the past data sets don't include what we are going to see. And so they're of limited use. We have to extrapolate forward and use scenario analysis to try to work out what will happen as temperature continues to warm. So what are the risks? We have a standard layout now of physical, transition and legal risks. The physical risks I won't spend too much time on because people are very familiar. The storms, the floods, the droughts, the wildfires, the hurricanes, which are increasing in number and increasing in severity. And there is data to support that from the insurance institute which collects that data over a run of time, and a lot of those are climate-related risks. And they will map into things like credit risks, including sovereign credit risk, market operational risks of the type we are familiar with. For me, the interest is in the transition risks. As an economist, I know the structure of the economy is going to change, both in demand and supply. People will be demanding different goods and services, simple case electric cars, perhaps more air conditioning, perhaps less single-use plastics. And on the supply side, well, renewable energy and changes to things like recycling all will change the structure of production in the economy. So the actual makeup of the economy going forward is going to change, but that will probably happen slowly. What's of more interest is actually the policy risks. Governments have promised to do something about global warming, and when they make those announcements about what they're going to do, that will come as a surprise, which could affect financial asset values. There's no reason why people sometimes say, oh, we'll get warned in advance, but getting warned in advance just means you get told earlier. It doesn't mean that you get any more transition time necessarily. And so the actual policies to mitigate climate change or adapt to it could actually be part of the risks. And that's interesting. That includes financial regulation. Financial regulation is on a path where it's getting tougher and tighter on this topic, and that poses a risk to firms that ignore it. And finally, we have the legal risk that people will get sued for climate change, either causing it or for not doing something about it. And I've got some information on that. First of all, to take it from the general to the specific, here's two charts of stock prices. One on the left is Pacific Gas and Electric, big utility company from California, which ended up in Chapter 11 bankruptcy. You probably know better than I, because of wildfires in California, which were blamed partly on the company's equipment or for their mismanagement of forests, were actually due to, of course, prolonged drought in those areas. So we have a direct link between a physical climate event and a company going bankrupt. So that's one. And on the right-hand side, we have Peabody Energy, the world's largest private coal producer, which also ended up going bankrupt. And that was in part, not wholly, but in part because of the Obama administration changed policy towards gas, particularly as fracking became available, and away from coal. And so arguably that is a transition policy-related risk, causing an individual firm that went to go bankrupt. And I have sat with investors who had both of these in their portfolio and lost all their money. So that going from the general climate risk through to very specific financial losses to investors. And on the legal risk, there's a database which tries to keep track of climate-related legal cases, which gets updated every year. Here's a map, not surprisingly, the majority in the United States, most litigious society, but Australia has got a lot as well, then the UK and continental Europe. This particular map didn't show any for Chile, but when I went into the database this morning, I found 4 cases in Chile that were listed as being climate related. So this is growing pretty much everywhere. Now, how do we think about this in terms of financial regulation? I think there are 2 legs, and you will hear people talk about double materiality. First leg for me is the most important, which is the impact of climate change on one's own responsibilities. And climate change does affect what regulators are doing, because it causes risks, material risks, to the safety and soundness of the firms you authorize. And so it's a direct impact on financial regulation. Also has an impact on anything a central bank does. It impacts on monetary policy, financial stability, all sorts of things. And so that should be uncontroversial. If something is happening in the world which impacts on regulators or central banks' objectives, you have to take it into account. Going the other way, we also need to think about the impact of our actions on the climate. For central bank, those will typically be fairly small. Directly. Indirectly, you're supporting the economy, so it will be about the transition of the economy. But actually, if you take action under the first leg, which is to reflect climate change as it affects your responsibilities, you will also do most of the work in terms of having the right impact, is my proposition. I'd just like to add a bit more detail onto this. Some people will say climate change is a moral, social, ethical, political issue, and it is. It's an existential threat that requires action from everyone. But not everybody will take action on that basis. A lot of central banks and regulators have secondary objectives to support government policies more generally, which enables them to take action. That's fine. But the primary argument is it impacts on all of the regulator's primary objectives. If there is a material financial risk to banks, to insurers, whatever firms it is you regulate, it's actually a legal requirement that you take it into account in your supervision and regulation. So this isn't about having a new objective or a change to mandates. And sometimes I like to list this as you should do something, you could do something, but actually you must do something because it's part of your objective and mandate as a regulator. So what are the issues? And I've divided this up here. I'm going to focus more on the regulatory side, prudential regulation, supervision, a bit on conduct regulation. I won't say much about that. Suffice it to say, at the moment, a lot of investors are looking to invest in green assets, but there is concern that they're being offered investments and funds and so on, which are not particularly green, which we call greenwashing, and it's the conduct regulator who has to take action to ensure that what is being sold to the end investor is what it says it is on the tin. To support that in Europe, we're developing green taxonomies to precisely define what can and can't be said to be green. And that's the length we're going to have to go to. If you want something that's going to stand up in court to say you missold this product as green, we need a technical underpinning for that will stand up in the court of law. I'll say a bit more about micro-prudential regulation in a minute, but just a note for central bankers watching, this does affect monetary policy. There will be more shocks to the economy through climate action, in particular supply side shocks, which push inflation up and output down at the same time. They will come through things like energy price shocks, as we're seeing at the moment, but also food price shocks as climate events hit world food supplies. And supply side shocks are much more difficult for central banks to deal with than ordinary demand shocks. There's a risk to financial stability should we get system-wide asset price repricing. We haven't seen that yet. We've only seen individual stocks move on climate news, but it is possible to get a widespread repricing. So financial stability worries are there. There is a very controversial issue about balance sheet management, and I've written a sole separate paper on that, which I don't want to go into today. We haven't got time. But basically, central banks do have the ability to influence green asset markets. And the big debate is how should they do that? Particularly right now, when there's actually a shortage of green assets rather than a shortage of demand to invest in them. So banks ought to be focusing on how to promote green asset markets rather than necessarily adding demand. And central banks and regulators alike, well, they all have internal processes. They are employers, they have buildings which require things like reducing energy usage and so on, and looking at their own processes. So let me come on to what I want to spend most time talking about, which is prudential regulation and supervision. Now, the conduct here, we did a report at Cambridge back in 2014. I've since written with the author, Kern Alexander, separately on this. The Basel system of regulation would allow supervisors to take climate risks into account without any changes. Okay, so you don't need to change the rules, the laws, or whatever. If climate risks are a material financial risk to a firm, they have to take them into account. They have to hold capital against them, and you don't need any special change to regulation. Now, you may want some because you may want to be very specific about it, but you don't need it. That's the point. So you don't need to wait for a new Basel agreement or for new laws to come in. You can just get on with it. Now, there are three pillars to the Basel system, which I hope at least some of you are very familiar with, probably more so than me. Basel system is a little bit antiquated, but there's actually quite a lot behind it, as you can see in this little picture of the three pillars here. As yet, where there is least action is on pillar one, which is standard minimum capital requirements. In Europe, they have been arguing for a green supporting factor to lower risk weights for green investments. That's pretty difficult to justify on a risk basis. Investments in things like wind farms appear to be about the same level as risk as infrastructure investments always have been. It's also difficult to implement something for an asset class which doesn't really exist yet. There is no definition yet of green asset classes beyond green bonds. But what is true ex ante is that assets which are exposed to carbon risk, fossil fuel industry investments, for example, or property in particular below sea level locations, they would carry more risk than currently implied by Basel. And so there would be a case for increasing the risk weights on certain assets, not for reducing them. Now, there is a Basel subcommittee working on that. It hasn't come to any conclusions yet, but they are very well aware of these issues. I know that because I interviewed the co-chair quite recently for an academic course. On pillar 2, there is a lot of progress. Now, this is about firm-specific idiosyncratic risks, where the supervisor should be engaging with the firm to make sure it is properly managing all its risks. And this is where I think most supervisors are starting to take action, looking at what commercial banks in particular are doing on their risk management front. If they're doing nothing, that clearly isn't correct. It's up to the commercial bank itself, regardless of the minimum risk weights, to calculate what capital it needs to hold against its climate-related risks. And the supervisors can simply say, you're not doing this properly. And there is a penalty for it. You can threaten to have a higher capital charge idiosyncratically for that firm if it is not meeting its requirements under the Basel regime. And the PRA, who are spearheading some of this in the UK, said they will be moving up through the gears in 2022 to impose the supervisory expectations on what their firms are doing. There's governance issues. In the UK, we have a senior manager regime, which requires there to be a senior person in the firm responsible for managing climate-related risks. The Bank of England are also doing coordinated stress tests across the climate-related stress tests across the leading banks to try and find out what the exposures are. And so there's quite a lot of action can be taken under Pillar 2 if the supervisor is up for it. Basically, it's a mindset thing. You have to be a supervisor that wants to engage and wants to do this, but there's nothing in the rules to stop you. And in fact, arguably, the rules say you should. Pillar 3 is where there's been most action globally, because this is market discipline through greater disclosure of risks. And in particular, the Task Force on Climate-Related Financial Disclosures has ensured that most large firms across most of the world are busy engaged on trying to work out what their climate-related risks are and disclosing that, and that includes the firms. In the UK and the EU, we are moving towards having mandatory disclosures on this. And I've just recently seen moves in the US from the SEC and the National Insurance Commissioners, National Association of Insurance Commissioners, also to make climate-related risks mandatory. So although the TCFD made voluntary disclosure recommendations, it's going to be required, which we've been saying for some years. We do have this problem of backward-looking data underpinning the existing risk industry, which we need to address. How are we going to calculate these risks when we don't have the right data set? And that's what most of the discussion is amongst chief risk officers. And we have the conduct regulation agenda I talked about earlier. So there's a range of things going on. As I said, specific action measures, supervisory expectations, coordinated stress tests, governance, disclosure. Coordination, one is worth mentioning, because no one firm, regulator, or central bank has really got the information to do all this on their own. And what we're seeing around the networks is people forming coalitions of different interests in order to address the issues. In the UK, the Bank of England and FCA set up the Climate Analytics Risk Forum for the banks to come together and be able to discuss the issues around measuring risk and taking it forward. Internationally, we have the NGFS. I'm pretty sure Chile is a member of the Network for Greening the Financial System and taking part in that. I help run the Cambridge Institute's group of banks that get together again to try to solve some of the more positive aspects. How can you make money out of the green agenda, basically? Because you can, by offering the right services and the right products. And banks are also working together on that. A selection of things on this chart around what's happening now. The top rank is things that central banks and regulators are doing of their own accord. The bottom is more things that are going on around it. I say stress tests, governance, risk management, network for greening the financial system, greening of balance sheets by central banks. At the moment, the Bank of England, ECB, and the Riksbank have all got as far as looking at their corporate bond holdings and wanting to tilt those away from fossil fuel related assets towards green assets. And the Bank of England has also published its own disclosures twice, its own TCFD. And there are also movements going on secondary objectives. The BOE asked the Treasury to make it explicit in secondary objectives. And we also changed that for the European Banking Association, EIOPA, and ESMA in Europe. So these organizations now have to take sustainability into account. Now, I'll stop there because we wanted short presentations to leave time for question and answers. But I hope that gives you the sense of where we're coming from. Central banks and regulators have to take this into account. I don't think it's rocket science to work out the ways in which climate change is affecting institutions, and it's up to regulators to make sure they are managing those risks properly. Thank you very much.
Many thanks, Dr. Fisher, for a very interesting presentation. We will now listen to Dr. Robert Patalano's presentations. If you have any questions, please type them into the chat box and we will do our best to answer them. Robert, over to you.
Yes, hello.
Oh, nice. Many thanks to overcome all the difficulties that you had.
Thanks. No, I'm actually calling in from my iPhone. Apparently, IT reasons, my computer wasn't able to, but if you can see on my iPhone, we're all set.
Yes, we see you and hear you very well. I don't know if you need some help with your presentation. Do you need that we pass it?
Yes, if you could upload it, that would be great, because I'm not able to do that.
Okay, here we are ready for that.
Oh, great.
You can see there. So the floor is yours, Robert.
Oh, okay. Very, very good. Wonderful. So why don't I start with just an introduction to thank, obviously, Bernardita and the Chilean authorities, the market regulator and the central bank. I really am impressed with your leadership on this issue on climate. So I want to thank you for inviting me for this session. I suspect Paul has already won. Is that the case? Paul has already
Yes,
presented.
right.
Yes, Robert. It's your turn.
So maybe we'll do it in reverse, in the sense that what I will do now is I will create the case. I want to show you some analysis that really tries to drive home how the current state of ESG and climate transition, despite a lot of impressive progress that's being made, really requires additional scrutiny by authorities and good practices by market participants. So that's really the nature of what I'm trying to do. And I want to thank also my colleagues. You can see on the slide here, several of my colleagues have really contributed to the analysis here, and that's driving the report. So maybe turning to page 1. So first, I want to tell you the good news in the first few pages. And what we can see here is that ESG ratings in investing are beginning to be mainstreamed across major markets. And if you look on the left-hand side, you can see, in terms of number of companies, we still have a ways to go. But on the right-hand side, if you see by market cap, what I'm trying to show you is that the vast majority of companies by market cap on stock exchanges are getting some form of ESG ratings from prominent ratings providers. And that's a good thing in essence, because it means these companies are disclosing, whether they're disclosing publicly or they're providing feedback to these rating providers, but it's starting to get them to think and to do due diligence about their challenges in terms of environmental, social, and governance. And that's good. That's good progress. Turning to the second slide, what we can see here is we have to ask a question. Why is so much effort being made in terms of disclosure and information and ESG ratings? Well, presumably, if we want to scale up climate finance and align with sustainability goals, we want to get a sense of whether the markets are actually doing something with this information that is change. Are they moving toward, rebalancing their portfolios, moving capital into the right direction? Because if we don't see it in the markets, we have to really ask ourselves, what's the purpose of all this? So we're seeing here, I'm giving you examples for auto companies on the left, the price to earnings ratio and the use of renewables, of renewable energy in their processes. We're seeing this interesting correlation over the past few years. And I say it's a correlation. Also we're seeing with oil companies the same relationship, but there are probably many factors that are correlated to the improved price earnings ratio. And on the right-hand side, you can even see it's also correlated with oil prices. So you have renewable use on one hand and oil prices on the other hand. So I guess my point here is we're starting to see evidence, we, academia, industry analysts are starting to show that there's a relationship, but obviously it's mixed and a lot more work needs to be done. And frankly, we need to, and I'll show you this in the next slides, we have to acknowledge that the current disclosure and rating regime really has a lot to be desired, so it's hard to tell where we're going. On the next slide here, I want to show you, yet another example of what's actually happening in the markets. What are we seeing in terms of the growth of funds? So I want to show you some what are called climate aware funds, which allows institutional or individual investors to put their money into some sort of investment that they think is sort of helping have a positive impact on the environment and on the climate transition. However, within these climate aware funds, you can see that a few of them, climate solutions, green bonds, clean energy, these are actually growing the fastest, as you can see on the left-hand side. However, on the right-hand side, if you have to ask, okay, am I reducing my carbon footprint? Am I reducing my carbon intensity? And in this case, we have to say that the climate solutions, green bonds, and clean energy tech funds actually are much more carbon intense than the average market. And, you know, that may be a concern for people who may think that they're aligning with good practice and environmental integrity. And in fact, they're going to need to do a lot of monitoring for many years to make sure that the issuers in these funds actually reduce their footprint. So that's something to be aware of. Turning to the next slide. Here we go. So now let's turn to a bit of the challenges in the market with disclosure and with ratings. So here we can see that climate transition metrics and products, you know, they really need to have greater alignment. What I want to show you here, I guess a key question is, to the extent that ESG should align with climate transition, should align with environmental integrity, we picked two metrics. One is CO2 emissions, and another is carbon intensity. And what I'm showing you here is that for several prominent ESG rating providers, you might think that somehow as you go from low ratings to high ratings, that carbon footprint would reduce in these companies, or even that the carbon intensity would reduce. And what I'm showing you on the left-hand side is that in 2 of the 3 cases, the carbon footprint actually increases. And on the right-hand side, we can't say that carbon intensity decreases. And in some cases, it's even higher for some of the higher rating companies. And that too raises questions about, you know, what is the E of ESG, and is it a metric that we can use either for central banks or regulators or investors as a proxy in any way for greening? I think, you know, that it really raises questions. Next slide, please. Great. So then what we tried to do is to say, if we use the E of ESG as a guidance, and knowing that a lot of institutional investors are integrating ESG into their investment choices, what would that do to a broad-based portfolio, equity portfolio, say in the S&P or in the European indices? You know, what would be the result? And what we're finding here is that tilting with higher E scores and tilting away from lower E scores, we end up with portfolios, and our calculation is that the portfolios actually have higher carbon emissions when they're using these E scores and traditional or typical tilting strategies. And in 2 out of the 3 cases, we result in portfolios with higher emissions. And that too is a concerning, to the extent that some investors don't quite realize that by using ESG and the E in particular, they can end up with higher emissions. Turning to the next slide. So this calls into question what exactly is being communicated in climate transition plans. They're growing in use. There's more relevance of the reporting, more following of TCFD. This is all wonderful progress, but we really need to understand then how markets and market participants use it, and is it supporting market integrity and environmental integrity? And what we're seeing here, my charts below show that certainly the disclosure of policies to improve emissions reduction and also targets to improve energy efficiency are more likely to be associated with higher environmental pillar scores. This is good, right? Better disclosure about policies, which is signaling intent toward a direction. This is impressive. And also we can see that disclosure of transition strategies and climate risk management, they're also associated with higher scores. All wonderful. Next slide. However, and let me just warn you, the next 4 charts are basically, they're colorful, but they're basically telling you no correlation. So what I'm saying here is that we're now looking at what are some hard facts, either backward-looking metrics or forward-looking metrics or current metrics that give us confidence, not just policy or governance or risk management strategies, but actual implementation and actions. And what I'm showing you here is that the disclosure of emissions reduction targets and the actual reduction of carbon intensity, such as on the right-hand side over the past 3 years, it doesn't appear to affect the E-pillar score at all. And it really raises questions if so many asset managers now are using ESG, if they're using the E, Are they capturing actual good practices from issuers? And that raises the questions as to whether they're going to reward firms that are advancing against their targets if they're using these frameworks. Turning to the next slide. Great. So again, very colorful slides, no relationship. What we're showing here is that our investors actually rewarding the higher use of renewables as inputs or environmental expenditures. And what I'm not showing is the same thing for environmental R&D and other factors. And what we're saying is these are the inputs. If you have a commitment to some sort of target, as an investor, I would want to know, what are you currently doing with your business model? How are you implementing your strategy? So I can get some sense on an annual basis whether you're moving toward your target. And yet again, what we see is that there's no relationship between these factors and any of the scores from several prominent ratings providers. And that too raises questions. Next slide. So we've shown this to asset managers and they're saying, sure, okay, but ESG, it's really an amalgamation of so many different issues and it's hard to extract climate transition from this, even from the E. And that of course, they're looking for long-term value and climate transition is only one part of that. So they were suggesting, well, if you really care about climate, start looking at climate frameworks. And of course, everyone turns to transition pathways and others, Climate Action 100 Plus, increasingly GFANs. There are different types of frameworks that are out there. And by the way, if you want to learn more about the frameworks in a nice, easy way, the NGFS just published a report on market transparency today. And the third chapter, which OCD contributed to, really gets into comparisons of these frameworks and their benefits and some of their drawbacks. So I'll just give you a taste today. And that taste basically is saying, if you compare the environmental pillar score of the major ESG raters to the transition pathway initiative, particularly the higher scoring companies that both have awareness and they're taking action to reduce their carbon footprint and intensity. What we're showing you on the left-hand side is of 4 providers, only one of them even has a minor correlation, R-squared of 0.2, showing that there is a relationship between the E-score and the promise of lowering carbon intensity from 2021 to 2050. What we would have expected, since we've heard from asset managers, no, we need to be looking forward-looking to see companies that are ambitious, and then we have engagement strategies to make sure they get there. But it's interesting, the E-score really doesn't seem to capture even that level of ambition. And then we said, okay, let's look at Transition Pathway Initiative and their carbon performances, the forecasts of firms with an excellent E-score and a high TPI level 4 management score. This is about the highest score you can get from Transition Pathway. And what we're finding here, and again, this is just a snapshot of some of these energy companies, but what we're finding here is even for those companies that scored very highly, what we're seeing in many cases, they're not really showing a high level of ambition in terms of either trying to achieve net zero. And here we're looking more at carbon intensity, but it's still a metric to help you reduce your pathway. And in some cases, they're not even below what would be expected by national pledges. So I'm giving you some snapshots here. We've done more analysis and we'll be publishing a report in May that will really go into more detail. I think we're seeing better practices with automobile firms that are really much more ambitious by 2030 of trying to hit net zero. So we do see some positive engagement, but I guess categorically, we still see a lot of areas where despite a lot of these scores that may mask the underlying data, unless you're really doing the analysis like we are, the practices are really mixed, and there's a lot of practice that really doesn't cut it in terms of what you would think would be investable from an investor that's climate aware. So turning now, we have a few recommendations, and hopefully this aligns with some of the points that Paul has made. First, actions are clearly needed by both financial authorities and market participants in terms of good practices to ensure that market practices are strengthened and better aligned with sustainability goals. We're not saying, of course, that every investor has to be aligned, but we're saying the practices and the products and the ratings, if they give the impression, if there's an E of ESG or climate aware funds, they need to be really transparent as to what the purposes of these products and methodologies and what they're trying to achieve, and have mechanisms in place that if there are promises, that there are actions and surveillance and engagement against those promises that achieve some sort of result. So the first is ensure global consistency and comparability and quality of the core ESG metrics. We want to promote transparency and comparability of scoring methodologies. We know, of course, this is proprietary, but you need to have some sort of explainability. If you have methodologies that are translucent and the end user doesn't know how you came to your score or what's driving it, that's concerning. And then we have to, this is an OECD perspective, but we should improve the relevance and precision of the E-score. So, if you can't tell that element of climate transition, there could be a sub-metric that would help us. And then in terms of markets and climate transition, greater use of granular forward-looking disclosure metrics, commitment to science-based targets, third-party verification of that to ensure integrity, and then overall stewardship plans are, as you can tell, all of this is saying that stewardship plans and investor engagement is really important, since there are a lot of long-term promises to make sure on an annual basis, the strategies and the implementations give confidence that these companies are moving in the right direction. And those stewardship plans need to make very clear, we're not saying divestment, but at the end of the day, if you're engaging, and after several years, these companies are not sticking to their promises, there need to be mechanisms to make them understand that's not acceptable. And there are a host of ways you can do that, from remuneration to votes against the current boards, et cetera. And then lastly, if I could just go to the final slide, and I won't go into detail here, but since some of you in the room are central banks and others are overseeing financial markets. Sorry, if you could go to the last slide. There should be one more slide. There we go. So just for central banks, and again, you can see this from the NGFS report as well that was just published. It's really important that if you're central banks and you're using this for market monitoring, for financial stability, or for own portfolios, however you want to use it, you really need to get underneath the hood of these methodologies to understand their strengths and drawbacks, what metrics they prefer, how they're weighting in order to make sense of it. And then for financial markets, there's a lot of movement toward mandatory climate reporting. It's really worthwhile, particularly in the event that IFRS is moving forward with its sustainability global baseline standards. With all of the effort to try and get baseline standards, it's important to make that effective across countries as a baseline. And then we need to have something on top of that when we're dealing with net zero science-based targets, interim targets, even annual, and progress against the pathway in terms of strategy and business model. It's important that we get more consistency, even above, if it's voluntary, but even above a global baseline, to make sure that the hundreds of metrics that are being used across the world, if not thousands in some cases, that there's some consistency and understandability and explainability about how they're using methodologies. And then, of course, third-party verification is really important, the assurance of that information that's coming out. And then, again, I think it's very important that for all of us involved, central banks, finance ministries, market regulators, financial markets themselves and associations, and then international organizations, as we're all very involved, to try and make sense and to help national authorities do cross-country comparisons to make sense of all this and come up with good practices that are globally integrated, interoperable, so that we can all benefit. So there we are. Why don't I end my presentation there? Thanks very much.
Many thanks, Roy, for your presentation. Now we are going to try to answer some of the questions that we had received. So the first question is for Paul. Paul, you recently edited a fascinating book called Making the Financial System Sustainable. One idea inside the book is about reconciling sustainable issues with the classic financial economics paradigm. Where are we now in the discussion? Which steps do you think it is crucial to take about these risk factors that can worsen in the next 34 years horizon that an investment practitioner considers? In the same way, the risk-based approach is one of the best tools to approach prudential supervision from a climate-related risk perspective. How much outdated is this framework? How to improve it? Paul.
Thank you very much for those questions. On the first point, I think economics has a long way to go. I call myself an economist. I've still got many colleagues from that sector. those economists who are working on this issue, I think, can contribute a very great deal to our understanding by using the logic and the discipline of economics. But the economics as a paradigm has a lot of constraints. It tends to be built around models. Those models are often assume an equilibrium, whereas what we're dealing here is an unstable trajectory. It's a bit more like unstable government debt dynamics in terms of a study. And a lot of the models that we would use in economics don't really apply for unstable paths. And again, most economists are used to doing marginal analysis rather than look at existential threats, as we're doing with something like climate change. And then in terms of quantifying it, it's quite hard to quantify models based on past data when the main risks haven't actually occurred yet and aren't in the data sets. So there's a lot of challenges there. They can be overcome if one is open to do it. But there's too many of my colleagues who still think, oh, just price carbon and the problem goes away. And it just doesn't work. I've actually written something on carbon pricing to demonstrate why it doesn't work like that. But too many people who haven't worked on it still will come back with that. So I think economics has a long way to go, but it also has an awful lot to offer if we can get more of our colleagues involved in the subject. The risk-based approach to prevention, and again, there is a chunk of that framework which is outdated. I spent a lot of my time being responsible for the Bank of England's balance sheet. And we employed all the traditional risk metrics, VAR and so on. And most of those sorts of risk management metrics are completely useless when it comes to crisis. You know, you get people suddenly saying, oh, there's a 6 sigma deviation, which just means you basically had your model wrong of what the risks were. And so we need a much more, I think, holistic view of what sort of risks are facing us, particularly in the tails. And it can be done. It's very interesting that the risk management done in the insurance sector is completely different in terms of the internal models they use. Is much different and much more sophisticated than those used by banks, for example, where the insurance internal models will do hundreds of thousands of stochastic simulations of balance sheets, assets and liabilities together with different parametric assumptions in them, whereas the banks, we might choose 3 stress tests. And so we do have the tools and they can be used. But I think basing everything on what the probability of default is and what the loss given default is using past data sets is far too restrictive for this sort of analysis. And people miss the obvious risks. All of a sudden they say, oh, my bank has been flooded. Well, because it never flooded before, so it wasn't on our risk register. And that's the sort of thing we need to sort of break the shackles a bit on. And risk managers, I think, it's too easy to tick the boxes.
Many thanks, Paul, for your answer. Robert, one question for you. You have writing about the challenges between more green debt and higher levels of indebtedness of companies. Today, we see how many countries have levels that haven't been seen in years, level of inflation, including Chile. Issuing debt is costlier now due to the higher interest rate levels. What type of strategies do you think SMEs can perform to overcome this restriction, specifically in green emissions? For example, are you prone to have sustainable stated guaranteed loans, which could be the role of the government in this issue?
Great, thank you. So let me first try to address that head on. First, there is an enormous amount of debt in the system. I was just speaking at a conference on debt and sustainability a few days ago, and in emerging markets and advanced economies, the amount of debt over the past 10, 20 years has really gone to unseen levels. And of course, over the past 2 years, COVID has had an impact on that, and that additional level of debt to deal with fiscal deficits to address the terrible impacts of COVID was entirely warranted. But of course, now it's left us with the prospect of trying to deal with higher inflation, with very high debt, with less fiscal room, the impacts from the Russian invasion, and then on top of that, the desire to scale up green finance, and green finance is a portion of the market, but then for all of the market to try and deal with climate transition for these companies, whether they're energy companies or any sort of companies that need to go through a transition to net zero, this is going to require an enormous amount of capital during a period where capital may become scarce, or at least will be much higher cost due to rising rates or the expectation of rising rates around the world. So what can governments do to help with that? So yes, I agree with your point that somehow governments, whether it's with infrastructure or with some form of implicit or explicit subsidies or guidance for blended finance, to try and provide green financing for SMEs. And there are some great examples in Europe where SMEs are getting funds from European funds, and also with public and private sector funding to try and scale up green for infrastructure, for small businesses, to make sure that they're both energy efficient, they're creating some sort of innovations to try and help with the broader climate transition, and this is welcome. And you can do that by making capital available, by changing the cost of capital, by changing the risks associated with that capital with some sort of subsidies or guarantees, and those are all welcome, and we're starting to see more examples across the world of how to do that. But I think of equal importance, and probably an area where I'm spending more of my time, is the concern about this high level of debt and climate transition. So you can imagine, to the extent that this transition becomes less than orderly, and given the delays in the scaling up of that transition, there's a growing expectation that it can be orderly, particularly in certain parts of the world. And the Russia invasion and the impact certainly is drawing attention to that. It's really concerning. So with higher costs of capital in the parts of the market that are becoming disorderly, that's going to start to have an impact on real economies, right? You're going to have over 3 trillion of leveraged loans, another few trillion of high yield corporate debt and emerging market debt. And if the climate transition starts to put a lot of pressure there and you have downgrades and defaults, then you're going to have negative feedback loops that really puts a lot of pressure on the credit risk premia at the very time that interest rates are going up. So the overall yield on that debt is going to be very high. And in many cases, it's going to start raising questions about broader debt sustainability at the very time where these companies desperately need capital, affordable capital, to make that transition. So let me end. Your question's a really valid one, because even beyond green, the broader transition, it's going to need innovative ideas and capital support from governments in different forms. And we need to turn our attention to that now more than ever.
Many thanks, Robert. I'm so sorry we had a lot of questions on our chat box, but we are running out of time. So we need to finish this panel because we have to be on a schedule. So Robert and Paul, very many thanks for your presentation and your answers. So I give the floor to Gabriel. So many thanks to all of you and our audience. Bye.
Thank you.
Many thanks, Commissioner Piedrabuena, for that skillful moderation of the panel. And as she just said, we're very grateful to Dr. Fisher's and Dr. Patalano's excellent presentation and interesting conversation. I think many interesting points were made here that we will need to study and go over again. Now we're going to continue with the second panel of the day, which is titled ESG, Market Development and New Disclosure Standards. And to understand and discuss these matters, we have two first-rate guests. We have with us Dr. Fabio Natalucci. He holds a PhD in economics from the New York University and a bachelor's degree from the Luis Guido Carli University. Dr. Natalucci is a Deputy Director of the Monetary and Capital Markets Department and International Monetary Fund. In that capacity, Fabio is responsible for the Global Financial Stability Report, which delivers the IMF's Global Financial Stability Risk Assessment. Before joining the IMF, Fabio was a Senior Associate Director in the Division of Monetary Affairs at the Federal Reserve Board of the United States. Between October 2016 and June 2017, Dr. Natalucci was Deputy Assistant Secretary for the International Financial Stability and Regulation at the US Department of Treasury. Many thanks, Fabio, for joining us today. We also have with us Mariana Escobar. Mariana holds a master's degree in international relations from Bentley University and a master's in international affairs and development from Columbia University. Mariana is currently an advisor to the Financial Superintendent of Colombia, responsible for the Financial Superintendency of Colombia's Green Finance and Climate Risk Strategy. Mariana joined the SFC in 2018 to support the design of the innovation strategy of the superintendency. Before working there, Mariana served as Deputy Director of Postal Affairs at the Ministry of Information and Communication Technology and as an advisor of inclusion in the Department of Social Prosperity. She worked at City Colombia as a sustainability manager and representative of the City Foundation in Colombia. Mariana, we are happy to have you with us today. I will now leave you with Dr. Natalucci's presentation. Fabio, the floor is yours.
Well, thank you so much, first of all, for the invitation, and it's a pleasure to be here. So what I thought I would do to start the discussion is to give you an overview of some of the developments in sustainable finance, green and IO, particularly in emerging markets, in terms of some of the dynamics we have seen in the last few years. Then pivot to some of the policy issues that have been raised. I co-chair one of the NGFS workstream on climate data gaps, so I thought I could bring in some insight from what we have done there. Then to broaden the discussion of what needs to be done to continue to foster a sustainable finance market with an eye on emerging markets. So that's my plan for the presentation. So if you don't mind going to the first slides. In terms of issuance, the next place. In terms of issuance, 2021 was a breakout year for emerging markets. There's been a significant acceleration in flows to both equities and funds. For example, in terms of bonds, there were almost $200 billion ESG-related bonds in 2021. That's about, if you want to make a comparison, about 50, 60 in the last few years. So it's a significant jump in issuance. The equities, it's a little bit more mature as an asset class relative to fixed income. So continue to see a pickup, about 25% year-over-year growth, with asset under management now totaling about 150 billion. Now, there's a number of reasons behind this pickup. Some of it has to do with awareness following the pandemic. Some has to do with acceleration in green strategies, particularly in Latin America. More generally, growing awareness globally about the financial stability implication of climate change. Now, it's also possible that another factor, apart from this factor, a cyclical factor, has to be the outperformance of the asset class. So as ESG securities, as you can see here to the right, have outperformed broader indices across a number of countries. Next slide, please. Now, an important point I think to make is not just the market has grown as an aggregate, but also the market has been growing in terms of different dimensions. So it's been maturing, if you want. So particularly, I'm going to be focusing here by growth by region, by type, and by sector. In terms of region, if you look at 2016-18 versus 1921, China has been a major leader in the segment. But as you can see from the pink bar here, the contribution of China in terms of the sector has declined over time, with other countries like Chile, India, Mexico picking up some of the share in terms of regional diversification. In terms of type of bonds, green bonds obviously remain the largest segment, account for more than 50% of total issuance in the last 3 years. But that is down from about 80. So that's a significant reallocation of share, particularly with other segments like social bonds or green bonds. And then finally, in terms of sectors, financials used to be the largest sector segment in ESG bonds. Other sectors have increased their share, particularly utilities and financials here. Now, importantly, utilities, energy are some of the key sectors that not only are leading this expansion, but also those are traditionally firms that could be non-ESG firms. So they might be trying to become more green. And I think that's an important point to make in terms of incentives in the growth of the sector. Next slide, please. Now, another way to look at this, is to look at the sector growth, is to think about EM financial stability, issues related to financial stability. So by looking at issuance by onshore versus offshore and across countries. Now, the chart to the left shows that 2021, as I said, has seen a sharp pickup in issuance, but not only in total issuance, that's the blue line, but particularly in offshore issuance, where ESG-related instruments at this point account for almost 20% of total issuance. And this is, I think, it's an important point that goes back to the issue of growth and maturing of the sector. This may be because ESG issuance at this point seems to be enjoying also a different, broader investor set when you think about international investors. Now, the chart to the right shows different emerging markets, how different emerging markets lies around different parameters. In particular, the x-axis shows the number of offshore, and the y-axis shows the number of total issuance. Now, one point to make. First, Chile is a clear dominant leader in the space, with about 25-35% of issuance related to ESG instruments. Second point, that Peru, it's a second distant, but second country to highlight. And then there are countries like Poland, India, where ESG instruments are a significant share of offshore, but not so much when it comes to overall issuance. Next slide, please. Now, when you start looking more clearly along two dimensions, right? So specific country differentiation as well as instruments. Now, there is no clear-cut pattern here that comes across here. I would say in general that every emerging market is unique on its own, as has its own specialization. For example, if you look at green bond, the second bar, this seems to be dominated by Brazil, China, Poland, and Mexico. When you go to green loans, the first column, those are very important for India, South Africa, and Turkey. When you look at sustainability bond, the fourth column, key are Malaysia and Peru. And this is important because I think it shows that the expansion, it's important, the growth of the sector is not important because it's growing across sectors, because it's growing across geography, but also it's expanding in terms of kind of instruments. And I think it's important because it can pick up different needs across different countries. And so as a variety of instruments, it's able to, one, it's to pick up some of the needs of the individual country, but also in terms of investor, right? So in some sense, this differentiation, I think is good both for demand and supply of ESG instruments. Next slide. Then finally, one more point about emerging markets, and that's going to help me to pivot to the policy part, is that there are three major challenges that emerging markets seem to be facing. The first one, and that's the first chart to the left, has to do with adherence to ICMA green principles, green bond principle. Now, there is a large variation among emerging markets. There's many countries that score very low in terms of this principle. So clearly there is big scope improvement in terms of adhering to ICMA green bond principle. The second point has to do with ESG score. 3 out of the 5 regions have seen declines in both sovereign and corporate ESG score post-pandemic. In part, this could be related to already downgrades, but clearly poses challenges for investors in terms of data availability and in terms of scoring, in terms of performance. And then last point has to do with data disclosure. That remains, in my view, the most important challenge for emerging markets. In terms of emerging market availability and quality and disclosure are quite poor, particularly when compared to advanced economies, as you can see to the right here. Now, within emerging markets, there is a big variation with Asian emerging markets like India, Philippines, Thailand, that seems to be lagging significantly. And within this, the environmental category has the largest data disclosure gap. Now, so if you can move to the next slide. What to make of this in terms of policy priorities? I think, again, going back to thinking about what the investor may be looking for in terms of increasing the maturity as well as flows into this sector, I think one is the role of climate data, right? So there's a need for robust, reliable, comparable climate data. Those are crucial for financial sector stakeholders, whether this has to do with monitoring financial stability from the public sector side, whether this has to do with supporting climate transition, so fostering growth of sustainable finance market, or whether this has to do with assessing firm level risk, for example, for risk management practice purposes for financial institutions. Next slide. Now, where are we in terms of data? Now, you can see that the percentage of firm, and this is taken from the TCFD related disclosure at the end of last year, that the percentage of firms that disclose climate-related metrics and targets has been improving, right? Both in terms of targets and metrics. Since the last 3 years, you have seen an increase of, but if you look at the level of the share of firms that report these metrics and targets, we are still south of 50%. So clearly there is the direction of improvement. It's where we want to go, but the level is still not where I think ideally we want to go. And I think part of the IFRS International Sustainability Standard Board work on this disclosure based on the TCFD. That could be an important impetus, I think, to increase this number. The second point is that also there's a difference across region, right? So if you look at the top 50 companies and that disclosure by region, clearly Europe is ahead of the game with almost 70%, followed by North America and Asia. But you can get, when you start getting into Latin America, Middle East and Africa, even looking at the largest companies, now we're starting to talk about 30% only of firms reporting. And then, of course, there is a difference across firm size, right? Again, improvement across the board, across firm side, but the numbers are still relatively low. So larger firm, say north of $12 billion, we see now almost 50%. But when you start getting to smaller firm, less than 3 billion, it's only 20%. So 1/5 of the universe. Next slide, please. Now, so what the work we have been doing in the NGFS in this work stream on bridging the data gap has been trying essentially identify data needs and data availability, implicitly pointing out to where data gaps and coming out with policy recommendation. And so the way we have done this is coming up with a user-centric approach aimed at identifying first the needs of climate data users in the financial sector, the stakeholder, and then setting up a repository of data needs, focusing on use cases, so data items, metrics, and use cases. And this repository actually has been, is out now for public consultation that is going to go through early May, I believe May 6 or May 7. So anyone that is interested in providing comments on the repository, it's on the website of the NGFS, and we very much welcome anyone who has views in terms of use cases that we identify, data we have identified, metrics, and whether we have missed any of those. Next slide. Now, to give you an idea, in terms of stakeholder, we have identified 6 stakeholders. So central bank, supervisor, financial institution, primarily bank essentially, insurer, pension funds, and other buy-side entities and investor. And then we identify 6 use cases. So exposure quantification, investment lending decision, macroeconomic modeling, financial stability, climate-related disclosure, and scenario analysis and stress testing. And this is how this repository is built. Now, to be clear, repository, it's not a portal where you go and get data for free, right? Think about this as a catalog. So you go in based on who you are among this stakeholder category and what your use cases. The repository give you a list of what is available in terms of like data sources, where to find the data, essentially. Next slide. Now, a quick summary based on what we had identified in May of last year when we published an interim report. And some of this, I think, has been confirmed through the work that we have done. That there's going to be, at the end, once the public repository consultation it's closed, we will finalize a final report that will be hopefully published sometimes in the next few months. Now, but what have we learned so far? I think one, this is a very crowded landscape, right? There's a lot of initiative on the table, particularly going to COP26 and coming out of 26. I still believe that the NGFS has a unique viewpoint here, has a very wide range membership, but clearly there is a pressing need for coordination of efforts and overlap, right? There's a long list of stakeholders now involved from the FSB, the G20, the IFRS, the G7. So clearly there's a need for coordination of efforts and avoid overlaps and use of scarce resources. Now, the main challenges that we have highlighted, one is that the largest data gap seems to be existent related to forward-looking data. Think about, for example, to emission pathways and targets. Second, there is a limited availability and granularity as it relates to carbon data, particularly Scope 3 emission, and then also the geographical data and asset location. This is really important, particularly for physical risk. And then number 3, there's a need for some assurance about the quality of climate-related data through verification, auditing mechanisms, as well as improving data accessibility. Now, toward this end, I think solutions like open source, for example, open climate, for example, open source climate, data collection, distribution through machine learning technique. I think leveraging of technology here could be really important in terms of making scalar information available in a more structured way, improving data access, for example, through geospatial data. This is a very fast growing field where images from satellites and space are used to identify particularly hazard and in physical risk, and allow insurance companies to tailor essentially their contract to the specific needs of some of their clients. Next slide. Now, just to close on terms of what has been done, the way we think about this at the fund, we call it the climate information architecture, and there are like three legs, right? One has to do with high quality, reliable, comparable data. I mentioned the NGFS bridging data gaps. FSB is doing work on this from the financial stability standpoint as well. There's also a need for harmonized set of climate disclosure standard. Here, what's being done again, IFRS, collaboration with the CFD or IOSCO. Perhaps the place where there's more work that needs to be done of the three leg is improving convergence in terms of climate finance classification. And we are doing some work here jointly with Rob, the OECD, Rob Patalano, as well as the World Bank and the BIS under the aegis of the G20 Sustainable Finance Working Group. Next slide. Now, what is the role of the fund in this, and how can we help with emerging markets? So we've been obviously covering climate from a financial stability, climate risk in a number of global financial stability report. This is the flagship of the IMF. Just to give you an idea, we had one chapter in October of last year where we cover, we look at this issue, particularly as it relates to transition risk in the investment fund sector. We also have a climate change indicator dashboard the statistics department produced at the fund. We are integrating climate risk analysis in financial sector assessment, particularly climate transition risk. And then we have been supporting international efforts, which I've already mentioned. So, and to conclude here, what are at this point the major challenges for emerging markets? And that takes me to my last slides. I think there are three main challenges. One is, like, as I mentioned, getting access to climate data. It's more difficult for emerging markets, right? Think about possible supply chain and availability of data, quality of data, and system in place to gather those data. The second point in terms of challenges and opportunity has to do with transition classification. It's a growing body of this. The OECD has been playing a leading role in this. Hopefully we'll bring some of this into this principal work that we're doing with other international financial institutions. Another international forum will be looking into this. And then number three, there's a need to lever up private finance, right? So if you want to finance the transition, the numbers of investment needed in terms of renewable and transition are huge. And so the public sector can't do it by itself. There's a need of use private finance. And how do we lever up private finance? All this is an opportunity, one, to diversify the industry base, and so bring more investors into the sector. Two, opportunity to invest in renewable, leveling up, crowding in private finance. And also, more broadly, we have done some work showing that in terms of ESG investor base, because of the horizon that this investor have, it seems to be so far to behaving as a little bit more stable investor base compared to the more sensitive to global factors in terms of capital flows. There could be a benefit from a financial stability perspective. And thank you so much again, and I'll stop here.
Thank you so much, Fabio, for an amazing presentation. We will now move on to Mariana's presentation. Mariana, the floor is yours.
Thank you, Gabriel, and to the CMF, IDB, obviously NGFS for hosting this event and inviting the Superintendencia Financiera. I'm just waiting for the slides to come up. But while they put them up, I just can presentation is going to be a structure around three themes: how the Superintendencia started its journey into ESG and climate integration into the financial system. Then I'm going to do a deep dive, I guess, on the taxonomy development that, as many of you know, it was launched 2 weeks ago, and it was a huge milestone for the Superintendencia, for Colombia as a whole. And then finally, I'm going to talk a little bit more on the disclosure regime or the regulation around the ESG disclosure. I'll tie it up with what Fabio just mentioned. I will reference certain things that I see for emerging markets as well. In general, not specific to Colombia, but obviously most of the presentation is based on the Colombian experience. So thank you very much. Please, next. So as many as you know, and for many financial regulators and supervisors in emerging markets, sustainability as a whole was mainly understood under corporate responsibility scope. So for many years, at least in the Colombian market, financial institutions and other supervised institutions in Colombia from the financial system understood sustainability from a corporate responsibility perspective. So we didn't engage much in these discussions. In the case of Colombia, what really encompasses or a big milestone in the financial market development for a greener financial system was around the Colombian Green Protocol. It was a voluntary protocol developed by the banking sector and the national government, which kind of publicly, where the banking sector publicly committed to developing 3 strategies. First, ESG integration in the risk management process. So basically developing their own ESRM systems. Secondly, around obviously financing and product development and innovation, green product development and innovation. And thirdly, around their own footprint. So their scope 1, I guess, if you want to call it footprint, to reduce their environmental footprint from their direct operations. As a result of the protocol, Colombia in 2016 issued, or the banking system issued the first green bond in Colombia. It was developed by the largest bank in Colombia. It's very important to note that the issuers in Colombia are mostly banks from the financial sector, even though we have from the real sector, the more active issuers, especially in this area, in the green finance area, it's our banks. And in this case, the largest bank in Colombia issued the first green bond in 2006. And since then, we have had many other issuance, green bonds issuance, but we also have social bonds that are picking up after the pandemic very fast, and obviously sustainability bonds. In the past couple of months, we have also seen past year, we have also seen an interest in sustainability-linked bonds, which for Colombia, it's very good news, because all these instruments, at least from the superintendent's perspective, facilitate also the transition of the economy, and it helps certain sectors that not necessarily are considered green to transform the way they operate. So, but basically in 2016, it was a milestone for greening the financial system, and it was the first issuance. And since then, we kind of we've seen many movements in the banking sector, many banks issuing their own ESRM system policies, developing their sustainability reports. Until 2018, that the superintendencia decides to jump into the discussion. It was included into the superintendencia's corporate strategy, I guess, if you want to call it, strategic planning. And we decided to explore a little bit more on how we could use these new innovative instruments, thematic bonds, in order to grow our capital markets. Emerging markets capital markets is quite small. In Colombia, we have only 68 corporate issuers listed in the stock market. So it's very small, and we saw the green bonds as an instrument that could help attract more issuers into the market. However, when we started to get update on what was going on in general in other emerging markets, and in general in other superpowers around the world, we realized that we had to open the scope, and that we were only not going to talk about opportunities, but we also needed to talk about risks. So since then, we also reached certain, or we developed certain I guess we made certain public commitments. So first we joined the SBFN, it's called today, which is the IFC Sustainable Banking and Finance Network, that helps emerging markets really advance on this agenda. They have a benchmark system, so that can become a roadmap. So it has helped a lot the superintendencia. We also joined, obviously, the NGFS. We were the second, after Central Bank of Mexico, the second authority in the region to join NGFS, and we have been working on different working groups there as well, in order to get some ideas and collaborate on how to green other financial systems. And finally, and I think for us was very important, we signed an MOU with the World Bank Group. So we both had help from the IFC and the World Bank. With the financial finance, however you want to call it, it's I think exclusively dedicated to the next slide, please. Thank you. What's the superintendents want to do more resilient financing from the risk perspective and opportunity perspective. So in order to do that, in order to really better and greater risk management around climate and ESG issues, we identified of work that we needed to work in the first. The second one, something happened with my video, but I'm going to continue and I cannot turn it on. So it's some technical glitch, I guess. Yeah, it doesn't let me go on. But anyhow, the second component was around innovative green instruments or innovative instruments that help foundation. We have been in this specific aspect. We want to really send a message to the market that send the message to the market that this issue needs to be aligned with the ICMA principles. So obviously, the fourth component integration. So here we also needed to kind of level up the promote.
Mariana, can you hear me? Mariana, can you hear me?
Tendencia and the super.
Mariana, yes. Sorry, can you hear me?
Yes.
Mariana, maybe we can make a very short break of a minute so you can look for better connection because we are not being able to hear you. Mariana? Mariana, can you hear me? Okay, so in the meanwhile, while Mariana looks for a better connection, I'm going to ask Fabio a question. So Fabio, you mentioned in your presentation the importance of data and how challenging data is when it comes to dealing with these issues, as it's the basis for everything. Now we're gonna see like mandatory disclosures in many markets. Most of data is coming from corporates and companies in the real economy. But as we know, implementing frameworks like TCFD that are sophisticated and difficult may take years. So how stringent should like ESG supervision be? How long, how hard, how tough should like security supervisors be in terms of disclosure?
I mean, that's a good question, right? So essentially it boils down to tailoring, and if you want to use the word proportionality, I think often it's used in financial regulatory work, right? So thinking about, I think at least along two dimensions. One is the dimension of time. And so how quickly you're going to go to full disclosure And you can think that that can be done in stages where, I don't know, for example, you start requiring a subset of data, and eventually over time you move to a broader set of data. Obviously, what you're going to start with, it's going to be a function of also what kind of firms are issuing ESG, whether these are corporates, financial, and so on. The ISSB, so the IFRS effort, I think ideally it's going to be a template that you can use, but you can imagine a situation where you're going to build on that over time. The second dimension, I think, has to do with size, right? Ultimately, this is going to be, if it's, especially if you're related to listed companies, you can imagine that you start with the largest companies, for example. And so again, over time, then you think about smaller firms. I think the issue is going to be more pronounced for one, emerging markets, where the share of largest firms, for example, may be smaller, the proportion of largest companies or listed companies compared to advanced economies, but also where SMEs may play a more important role in the economy. And so in that case, what do you require from SMEs compared to the largest company? So I think tailoring is going to be very important to the specificity of the individual country's economy and financial system. With one caveat, that there is a trade-off between tailoring and specificity and global convergence, right? So the more you move into tailoring to the needs of a specific country and its specific financial institutions and financial system development, the more, in some sense, you move away from global standard. And I work at the fund, so I have to give the little speech on global standards and the importance of international cooperation and so on. Also for not just for policymakers, I think it's important also for global firms, right? So if you want to attract global investor, the more you move at the right pace over time, but towards some global standard that are used in different across financial markets, I think the more you're going to be able to attract large investors, global investors. The more you make it tailored and specific to that specific countries in terms of not just data, but also disclosure, classifications, maybe, the more it's going to be a fragmented global financial markets, and the more difficult it's going to be to attract global investors. So that I think is trade-off. Personally, I think one way, again, to solve that is to think in terms of time dimension, right? So your goal should be to go back to this global standard, the IFRS. Perhaps countries may take a different pace to get there in terms of making it mandatory, in terms of what to disclose initially, and so on. And you can also learn by over time, right? There's going to be clearly things that you're going to be learning when you start asking for disclosure and data quality. So the data quality, it's really important here. If you don't have the right data, everything else in terms of both classification and disclosure goes out the window if people don't trust the data quality.
Yeah, that's definitely a huge challenge. Just to give you an example, in Chile, we have adopted SASB standards, which are now going to be absorbed by the ISSB from IFRS, probably. And yeah, we have the challenge. Most of SASB standards are think for the US or for, say, global north markets. So when it comes to Chilean regulation or Chilean standards, there are lots of questions, and we're working hard on that. And that's definitely a challenge. How do you see like the developments of the ISSB? How do you see like their adoption, and do you think they're going to become like a mandatory standard like in foreseeable future, or that's going to take a while?
So I sit on, they created an advisory body to the ISSB. It's called Sustainability Consultative Committee, where there are 4 international institutions that sit there as permanent member, the IMF, the bank, the OECD, and the United Nations. And so, and that consultative body will expand also to include specific experts. So we're working on that. So I think they have something out for consultation. Now I'm going to spend the day publicizing consultation. I think it's very important that people provide their views into the process, right? This is just the beginning, right? There are this exposure draft, one on sustainability, more broadly speaking, and then one specific on climate. The build, as you said, on this already existing effort, they had the prototype before the exposure standard, the OIOSCO was involved, TCFD was involved, and a number of the international efforts seem to be converging toward it. So I think this convergence is really, really important. Again, the goal is to promote convergence and make global standard, right? And then think about this as a building block approaches. Some jurisdiction may decide that they want to go beyond this. For some other jurisdiction, this could be a minimum, but building on something that is global for everyone, I think is crucial. We are still at the beginning of this process. And again, the consultation is open until July. I forgot the exact date. I think it's really important to get comments from stakeholder, right? Because this is a huge effort. The IFRS has been going super fast on this. If you think about it, just announced the ISSB at COP26, right? So if you compare the speed of this with the speed of the traditional accounting standard, then this has been like really, really fast. So getting feedback at this stage, I think is crucial. But again, you can't talk about just disclosure or even classification. You need data, right? So I can give you, suppose magically, I have like, I don't know, a magic wand, I make everyone use the same one classification in the world and one disclosure. If we don't have the same good quality data, if data are not comparable and consistent across jurisdiction, it's like a bookshelf, right? We all use the same bookshelf, but if you start using books in different languages, it's going to be really hard to actually use those books in those bookshelves. And so this is the same story here. We need to work on data. We need to start from data. And that challenge it's a bigger challenge for emerging markets. I mean, there are good examples. Chile, you could see in the chart I show how it was jumping out of the chart, right? And so there are also lessons to learn from those who have moved much faster than others in the ESG space. And so learning from you guys, I think it's really important for other emerging markets. So with all the specificity and unique challenges that then different countries face in terms of their unique transition. But it needs to start with the data. And so getting feedback both on the NGFS consultation in terms of the data repository, as well as the IFRS effort here, I think it's really, really important to get feedback because you might be missing something. There might be specific circumstances that have not been considered. So that's going to be the starting point to see the direction of travel at this point.
I see. I mean, yeah, it's a challenging thing, but things have been moving very, very fast, as you said, in the IFRS side, and it's going to definitely help establishing a standard. And thank you for the flattering word for Chile. We have lots of challenges going forward. We'll give it a try now. Apparently, Mariana has connected from her phone. Mariana, can you hear us?
I can hear you. Can you hear me?
Yeah, we can hear you loud and clear. Great.
Okay.
So let's give it a try going back to your presentation.
Well, so hopefully I will be able to finish. Thank you so much for your patience. So basically, while they put the presentation back up, so the Superintendencia designed this strategy that basically wanted to do two main things. First, help financial market participants mobilize capital towards green growth objectives, environmental objectives, and commitments we have in Colombia. But secondly, we also wanted to promote a greater and better climate and ESG risk management within the institutions we supervise. So we identified 5 different areas of work. The first one was around taxonomy, which I will talk about it later. The second and third one are around thematic and other innovative financial products. We wanted to keep promoting clear frameworks for this type of innovation to avoid greenwashing. And here to reference Fabio's presentation, we really wanted, especially on the thematic bonds area, we really wanted the market to get signaling from us regarding the ICMA alignment. No, we really want, under the regulation we have designed in Colombia, it's aligned the ICMA principles, and we are sending clear messages to issuers regarding the importance of these principles and its alignment when issuing this type of instruments. The third aspect is around ESG disclosure. We know that you can, and I think this is the central theme of this conversation. So without proper ESG disclosure, it is very difficult to promote or to engage, especially institutional investors in Colombia, to integrate these issues into their processes. So we develop an action plan around ESG disclosure that I will also talk about it later. The fourth component is around ESG integration, as I mentioned. So when we develop, in Colombia, we develop a climate risk, an ESG risk and opportunity survey. And what we realized when issuing this survey and when analyzing the results is that the different industries we supervise were at different levels. So we wanted to really encourage and nudge institutional investors to really step up their game. The banking industry was leading the way in Colombia, and we needed the institutional investors to come up to their level, to the banking, what the banking was doing, no? And to understand the key themes and concepts. And finally, and this has to do more with what we do as a superintendencia, and it was around the tools we have to identify and assess the impact of climate change into financial stability. So we decided to start exploring with different tools and different approaches to assess this impact. So we have been conducted different exercises, but the most visible one was a vulnerability analysis we did for the banking sector regarding physical and transition risks. This exercise was done with the World Bank's help. Next. Before I continue, I just want to confirm, it's everybody listening to me okay? Is it working perfectly, or like the sound, the system? Yes? Gabi, should I continue?
We can hear you very well.
Okay, good. That's good news. So basically, and in line with what we're trying to do, in line with the theme of this panel, and as you could see from the strategy, transparency was a central theme. So even though the taxonomy, the initial driver to develop the taxonomy was around opportunity identification, we do know that having a taxonomy, it's also a way of encouraging and promoting greater transparency. Obviously, the ESG and climate reporting regulation that we issue, it's going to increase data that we need, but also transparency on how the different, in this case, issuers in Colombia are assessing and managing climate and ESG issues in their businesses and conducting their operations. And finally, and obviously, and what I just mentioned regarding the green product or product innovation around green finance, what we want to do is also develop frameworks that increase transparency when innovating and denominating or labeling products with their green last name. So transparency is at the center of what we do. So I'm just gonna go a little bit, and as I mentioned at the beginning, I'm gonna deep dive on the taxonomy and on the ESG and climate reporting framework or reporting regulations and the frameworks we reference in the regulation. So next. So regarding the green taxonomy, so as what we decided to do in Colombia, and as I mentioned before, one of the reasons for developing the green taxonomy was on the opportunity identification side. So when we conducted this climate and environmental risk and opportunity survey, one of the main barriers we identified from the survey and that the different supervised institution mentioned was the lack of a labeling system or a lack of common definition is a barrier to identify and mobilize capital, not to identify opportunities and mobilize capital. So we decided, and that's the main driver, we decided to start developing a green taxonomy. Another of the main drivers for developing the taxonomy was around the benefits issuers saw when issuing these thematic bonds. So when we talk with different issuers in Colombia, one of the reasons they mentioned, or one of the benefits they identified for issuing this type of theme instruments, debt instruments, was around investor. So as I mentioned, Colombian capital markets is very small, and when you have this type of incentive, it gave us, it kind of highlighted the importance of giving these new investors, this new investor base we're attracting to Colombia, a language to understand what in the Colombian context could contribute substantially to these environmental commitments. So we decided to base our exercise and to base our exercise on the EU taxonomy, even though we referenced different taxonomies. Obviously, we referenced and we collected information or understood how issuers were aligning with the CBI taxonomy. We also studied the Colombian what we call the monitoring, reporting, and verification system for climate investment. So we also understood what the IFC was doing in emerging markets regarding these thematic bonds and these products that had a green last name. And after we conducted that assessment on the different taxonomies, we decided or we identify a series of activities that were arranged or organized around 10 economic sector and 7 environmental objectives that were prioritized in this exercise. As you can see, the environmental objectives that the taxonomy covers are similar to the environmental objectives you see in other jurisdictions. Again, one of the things we wanted to do is facilitate interoperability, or at least facilitate the architecture when developing the taxonomy for institutional investors and international investors that want to invest in the country, to understand how this to better manage and navigate this taxonomy, and to better understand how to use it when taking a decision, an investment decision. Besides the 7 environmental objectives we identified, the way to organize these economic activities, these eligible activities, we first conducted a filter. The filter was basically on the relevance and substantial contribution of that activity to mitigation and adaptation objective. Once we filtered the activities, we defined eligibility criteria and thresholds. So basically the KPIs or the conditions, the technical conditions, the asset or the economic activity needed to comply with in order to substantially contribute to mitigation, to climate change mitigation and adaptation. And finally, what I have translated into what we call treatment of risk, which is no other, which in the other international taxonomies, it's the do not significant harm principle. One of the biggest challenges we have in Colombia, and I am assuming this is going to be a challenge for other emerging markets when developing their own taxonomies, is around the application implementation of the do not significant harm principle. When you see the European green taxonomy, they have a lot of local regulation, green regulation that they can reference for the taxonomy users to apply. In the case of Colombia, we didn't have the amount of regulation needed in order to really identify a do not or a structure the do not significant harm principle in the taxonomy. So the way we approach this do not significant harm principle is around the treatment of risk. So in many issues we reference, for example, the ESRM systems the bank or the financial institutions have as a way of making sure that the environmental activity or the asset they are financing is not or impacting negatively the other 6 environmental objectives. Next. Around the sectoral scope, as I mentioned, the taxonomy covers 10 activities. So the first 5 activities, 10 sectors, the 5 sectors are the sectors that substantially contribute to climate change mitigation. So the thresholds identified or the KPIs identified for the assets and activities are the ones that contribute substantially to mitigation, to climate change mitigation. Then we have 2 activities, 2 sectors that identify activities that enable the first 5 activities that enable the activities, energy generation, sustainable construction, sustainable transportation. So these activities basically the first 5 activities, and then we have the land use sector. So these 3 activities basically differ completely from what you have seen in other taxonomies. It was these activities, assets and activities that were mapped there, and the approach to develop the thresholds are completely different from other taxonomies. And the reason for that is because land use in Colombia is very specific, and what has been done in other countries or jurisdictions do not apply to Colombia. So these 3 basically activities that are associated with land use, their approach is it's more around the different how different good practices contribute to the different objectives that were prioritized in the taxonomy. Next. One of the questions we get asked the most is around implementation, and this is a discussion actually we had with the Chilean colleagues when talking about taxonomy development. In the case of Colombia, and I think it differs a little bit from the European Union, in this phase, the taxonomy implementation is going to be focused on the product labeling. So many of the different regulations we have issued around innovative green products reference the green taxonomy. What we want to do for the different issuers and supervised financial institutions is that when they label a product as green, they need to inform the market, publicly inform if and how they are aligned with the taxonomy. We do know that in the European Union, in other jurisdictions, the disclosure regime also looks for taxonomy, for disclosure around the taxonomy, but in our case, it's in this first phase, it's going to be focused on product labeling. Next. So I have only here around 2 slides. Basically, so as I mentioned at the beginning, in Colombia, we identified, and Fabio mentioned, in Colombia, we identified or we realized that sustainability reports were not responding to the financial market participant needs. The information was not comparable. It was not relevant for investors. The quality was low, especially because we didn't have external assurance. And when you ask the issuers of the reports, they also had a lot of fatigue. No, so there was a lot of GRI sustainability reports, but they were also getting a lot of surveys, questionnaires, and other type of requests regarding additional information they were not issuing in their sustainability report. In order to really have more tangible data to kind of justify or understand a little bit the disclosure landscape in Colombia, we conducted, with the help of the World Bank, an assessment. And as you can see, I don't know if it's too small, but most of the disclosure was around social issues, especially their issues around employment and how companies treat their employees. But when you go into the environmental side and to the governance and obviously the alignment with TCFD, we see that there is very low disclosure. So we decided in Colombia to conduct or to develop or issue a regulation. So if you could go, please, next. This regulation basically looks or wants for the issuers in Colombia, so it's not only supervised institution, but issuers in general in Colombia, to comply with, for climate-related issues, to comply with TCFD or to develop their reports with aligning with the TCFD principles, and for other ESG issues to comply with SASB. This is very important for me to one of the big questions we have when designing the regulation was around the scope, the thematic scope. When we engage with the market participants, both issuers and users of the reports, they did mention that in countries like Colombia, so I think this is going to be the case for most emerging markets, starting or asking the market to only report on climate or to disclose the information around climate related risk and opportunities is not enough. They ask for issuers, and issuers also wanted to disclose information around all other ESG issues. So the decision we made in Colombia was to align the regulation with these 2 practices. Obviously, facilitating on or making the clarity that whichever decision the IFRS takes and how the framework or the landscape, the disclosure and reporting landscape evolves, the regulation will adapt to those changes. So this regulation was issued last year, in December last year, and it will come into place or it will become mandatory next year. So the biggest issuers need to comply with both the CFD and SASB, and the smaller issuers are going to start just with SASB. Next. Here I am going to be, I'm not going to take very long, but I just wanted here to clarify that one of the reasons we chose and the reason we align with TCFD and SASB, besides being frameworks that, as you can see from the international discussion, are at the center of the IFRS strategy and plan, and We also, for us, for the Superintendencia, and taking into consideration our mandate, we wanted to focus on financial materiality. We saw a lot of double materiality reports in the country. Colombia, I think, is the 5th country with most sustainability GRI and sustainability reports in the world, but we needed to strengthen the position, or we needed to strengthen the information that was being disclosed from the financial materiality perspective. So we did focus, and in the regulation, we specified that we needed to strengthen and that we wanted to really increase the quality, comparability of the data from the financial materiality perspective. Next. Finally, I have some final thoughts on the emerging markets regarding taxonomy. One of the biggest things we want to put out there is around transition taxonomies. When we put the taxonomy for consultation, we did get many comments around transition activities. And I think for when developing green taxonomies, this is one of the key decisions that the jurisdiction needs to understand and make a decision on which one should be developed first. It's very important because the rest of the process can run out smoothly. The second thought is around the implementation. As I mentioned before, in Colombia, we made a decision on the implementation regarding product labeling, but I do know that in the jurisdictions, it could be around the disclosure regime, the corporate disclosure, not the product disclosure. So that's another decision that it's important for emerging markets to understand and to understand their context when implementing the taxonomy. Regarding on the disclosure side, and also on the product development side, it's around innovation and regulation and which one should come first. So we are developing, we develop a green bond regulation. We are issuing, we already presented for public consultation the sustainability linked bond regulation. And one of the questions we had internally at the Superintendency is which one should come first? Should we let the market develop a little bit more, or should we create a framework that sends clear messages to all issuers? And the same with the disclosure regime. One of the decisions we took is we didn't want to wait for the IFRS. We wanted to prepare the market for what IFRS was going to issue. So we decided to issue the regulation first. But I do know that for more emerging markets, it could be very costly, especially for issuers. And some emerging market might choose to wait for the IFRS to issue their documents. And that's it. I'm going to stop here. And again, thank you very much for your patience on the technical issues.
Thank you very much, Mariana, for a very thorough presentation. And we will use these very last minutes to make just one question to each of you. And I'll start with Fabio. So you mentioned in your presentation, among many challenges and opportunities for development markets, the need to lever up private finance. So which kind of policies do you think would help most to do this? For instance, are taxonomies a potential kind of wildcard that may increase and help this to happen?
So I think what I mentioned here, there's different ways to do this, but one possibility would be to use public money perhaps through the international multi-development banks, and think about how to lever that up, right? So how to attract investors into emerging markets. You can think of different structure. There are frameworks where you can provide credit guarantees or credit enhancement, or you can think of financial engineering where you use some sort of public money, for example, and you lever up to absorb some of the losses, and then lever up private finance by providing, essentially reducing the aggregate cost of investment in renewable, with the private sector willing to be there in terms of first loss. I think this is something we need to think more carefully, and how to bring public money in, what is the right venue to do that, whether the existing international financial institutions are set up to do that or not, or we need something new. I think those are some of the challenges, but clearly the numbers out there, when you think about investment, I don't know, in infrastructure, for example, or investment in transition, we're talking about trillions, multiples of those trillions. And if you look how much public money has been used so far, and there's example and pilot schemes, but we are usually missing 3 zeros between what has been done and what is needed. And so how to lever up from the available resource in public money and invite private sector to come in? What kind of schemes do we need? I mean, consider also that some of the public finance now are being challenged by the pandemic, right? So some of the increase in debt and fiscal position has deteriorated because the need to protect the most affected by the pandemic. So how to use the existing public sector resources. So I was mentioning, what I reminded was thinking about financial engineering as a way to lever up existing public finance and bring private sector in. Now, let's stop quickly. Of course, it's not just financial engineering, it's also creating the environment as we've been discussing now for this hour in terms of data, in terms of disclosure, right, in terms of classification. It's not just getting the money in. They need to bring them in and make also attractive from investor need to be able to price risk. The only way to do that is by having good quality data and have disclosures.
Many thanks, Fabio. So I guess as a kind of final remark, you need not only the investment, but the right framework for the investment. Yeah, thank you. Mariana, very briefly, you mentioned and stressed out the importance of financial materiality in your presentation for disclosures and how you focus on that. How do you think supervisors, the ones that are going to actually do the oversight of this disclosure, are going to do that judgment of the materiality?
I think that's one of the biggest challenges, Gabriel, getting to, I mean, normally when supervising the data and the disclosure issuers provide and their practices, normally, and in Colombia, we rely a lot on external verification. And I'm here very transparent. In this case, we are not relying on external verification. We didn't. It's voluntary in the case of the Colombian regulation. So there is a challenge. One of the reasons we decided to basically leave a 2-year gap between the issuance of the regulation and the actual enforcement of the regulation is because we needed to build capacity both at the market level but at the supervisory level. And that's going to be one of the biggest challenges. One of the things we have to focus and we're going to engage a lot with this, especially with SASB, and try to understand how to see if this is being implemented by some of the biggest issues in the market, is to really build that capacity for supervisors to understand the approach and the methodology to assess the financial materiality of the issues that is being disclosed. One of the things we specifically mandated in the regulation and is that they need to also disclose the process to assess that financial materiality. And I think that information is going to be key for the supervisors when actually assessing the information that is being disclosed from the issuers.
Mariana, many thanks for that answer, and many thanks again to both of you for great presentations, very complete, and you gave us an amazing view at a global or regional level and also at a local level of how does it look to promote this kind of market. So many thanks again. And now we will pass to the closure of our first climate-related financial risk conference, which will be given by the Vice Chair of the Financial Markets Commission of Chile, Dr. Mauricio Larraín. So Dr. Mauricio Larraín is a PhD in economics from the University of California, Berkeley, a master's degree in financial economics from Catholic University of Chile, and an economics BA from the same university. He began his career as an economist in the Department of Studies of the Central Bank of Chile. Later, he was a professor of finance at Columbia University Business School in New York. His research has been published in leading financial academic journals and has presented papers at Harvard, Columbia, Chicago, Oxford, Cambridge business schools, and at the World Bank and the International Monetary Fund. Dr. Larraín is the sponsor of the Climate Change Strategic Initiative and the Climate Change Working Group of the Financial Market Commission. I will now leave you with Dr. Mauricio Larraín, Deputy Chair of the Financial Market Commission of Chile. Dr. Larraín, the floor is yours.
Thank you very much, Gabriel, for the nice introduction. Let me share my screen. There we go. So I would like to start by thanking the conference organizers for setting up this very nice conference on climate risks. I would also like to thank the speakers for sharing their experiences with us and providing very useful insights, and also to all the audience for participating actively in the event. The purpose of my talk is to present the roadmap of the Financial Market Commission, the CMF, regarding climate change and the development of a sustainable financial market. I want to transmit to the public about how the CMF views the climate change problem and how we plan to address it. I will start the presentation with the introduction to the problem, how the CMF views both the risks and opportunities of climate change for the financial sector. Then I will explain the response of the CMF until now to climate change. And finally, and more importantly, I will explain how we plan to move forward on this topic. So let me start by explaining the role of the CMF on climate change in a highly exposed country like Chile. And then I will explain how we view the risks and opportunities of climate change. So just as a reminder, the Financial Market Commission, the CMF, is the integrated financial supervisor and regulator of Chile. We oversee three main financial sectors, which is the banking sector, the insurance sector, and also the securities market. To understand the role of the CMF on climate change, we first have to understand the CMF's legal mandate. And by law, we have three clear objectives. One about solvency and financial stability, another one about integrity and market conduct, and a third objective about financial market development. And climate change threatens the achievement of each of these three objectives. And therefore, it is part of the legal mandate of the Commission to face the climate change problem. As you already know, Chile is a country that is very sensitive to climate-related and environmental risk. And its economy is widely exposed to these risks, which makes the climate change a problem very critical for the financial sector. Climate models show that severe decreases in rainfall, droughts, water shortages, wildfires, and extreme temperatures are all highly likely phenomenon in Chile. In fact, Chile is recognized as very vulnerable to climate change impacts, and overall, our country is ranked 29 out of 181 countries in climate change vulnerability, according to the Notre Dame GAIN Index. The transition towards a low carbon society will therefore affect strongly the energy sectors, the transportation sectors, and manufacturing sectors, among others. And all these changes entail, on the one hand, risks, and on the other hand, opportunities. So let me start with the risks. So the CMF is addressing several sustainability-related risks, among which climate-related risks are our major concern. So there's a broad umbrella of sustainability-related risks, which consist of ESG risks, which we have talked throughout the conference: environmental, social, and governance. And climate risks are actually a subset of the environmental risks. We can decompose climate risks in two main categories, which are the physical risk and the transition risk. And within the physical risk, we can also divide them into acute and chronic risks. Acute risks include extreme weather events, extreme rains, tornadoes, etc. Chronic risks, on the other hand, include global warming, changes in rain patterns, increases in sea levels, etc. That's the physical risk. And then the transition risks are basically driven by changes of society towards a low carbon and more climate-friendly economy. Think about carbon taxes, decarbonization, closure of coal-fired power plants, among others. At the CMF, we pay special attention to the transmission channels through which climate-related risks can magnify standard financial risk, such as credit risk, market risk, etc. So as a starting point, we have the risk generators. Think about extreme weather events, gradual changes in weather patterns, legal and regulatory changes, among others. Now, these factors affect firms, corporations in the real economy through different channels, by increasing their cost structure, business interruption, disruption in supply chains, volatility in commodity prices, etc. And all these channels in turn amplify the traditional risks that the financial system faces. For example, credit risk. So when a corporation is adversely affected by a climate shock, the firm is less likely to pay the debt it has with the creditors. That is, the probability of default increases. This in turn reduces the value of the loan portfolio of banks and also the value of the investment portfolio of insurance companies which invest in this corporation. And in addition to credit risk, climate risk can also amplify other type of traditional risks, such as market risks, operational risks, and also even legal risks. So that's the risk side. Now let me talk briefly about the opportunity side. And I would like to emphasize at least two different sources of opportunities that are relevant for Chile. So first, Chile has been a leader regarding the issuance of green bonds. What is a green bond? It's a bond in which the issuing proceeds are used exclusively to finance projects that have a positive environmental and/or climate benefits. In fact, Chile was the first country in Latin America to issue a green bond back in 2019. Moreover, Chile also issued the world's first sovereign sustainability-linked bond last month. What is a sustainability-linked bond? It's basically a new type of general purpose financial instrument in which the bond coupons, that is the financial cost of the instrument, are tied to an issuer's sustainability key performance indicators. The idea is that sustainability-linked bonds can bring tractable metrics to support the sustainability ambitions of the issuer. So that's one opportunity. Another opportunity has to do with renewable energies. Chile is also one of the most attractive countries for investment in renewable energies. Basically because Chile's world-class renewable sources means that wind and solar sources of energy will play a key role in its energy mix. These technologies, what they do is they steadily push conventional plants out of the system, cutting reliance on coal, gas, and other fossil fuels. Today, renewable electricity from solar and wind power in Chile represents around 20% of the country's total energy supply, and the volume of renewables is expected to increase steadily going forward. Moreover, Chile also has a unique opportunity to develop a competitive green hydrogen industry that, from electricity produced with low-cost renewable sources, forms an energy source for local use and exportation, and at the end promotes a sustainable economy around. Now, let me talk a little about what has been the response of the CMF until now regarding the climate change problem. And we have done actually several things. So at the end of 2009, the CMF signed the Green Financial Sector Agreement. This is an initiative that is led by the Ministry of Finance of Chile that brings together public and private representatives with one aim, which is to contribute to financial stability and to achieve the country's climate objectives. 2019, we also became member of NGFS, the Central Banks and Supervisors Network for Greening the Financial System. The objective of this institution is to contribute to the exchange of experiences and best practices for proper climate risk management in the financial sector and to support the transition towards a more sustainable economy. At the beginning of 2020, we performed a strategic plan within the CMF, and the plan contains an explicit strategic initiative related to climate change. I have the honor of being the sponsor of that strategic initiative. Moreover, we created what we call the Climate Change Working Group inside the CMF. This is a group formed by a group of high-level CMF professionals. It's a very diverse group with staff coming from different parts of the CMF, working on banking, insurance, and security sectors. And I would like to actually take this opportunity to give a special thanks and recognition to each member of this working group for their fantastic work, all their dedication and passion for climate topics. Towards the end of 2020, the CMF published its strategy to face climate change. In 2021, we published an important regulation that requires firms to disclose sustainability-related information. These entities will have to report about their policies, their practices, and their goals regarding ESG matters. And we also created a Sustainable Finance Information Oversight Division in the CMF to supervise this new regulation. This division is headed by Gabriel Acuña, which is one of the organizers of the conference, and we're very happy to have him heading this new division. Now, let me talk briefly about this strategy of the CMF regarding climate change. It is a very important document that summarizes our view regarding climate change. I encourage all the audience to download this document from the CMF website. And what the strategy basically states is that climate change is a relevant source of financial risk and that it poses a threat to financial stability, to the efficiency, and also to the integrity of the financial market. As I explained before, the CMF has determined that climate change is a strategic priority within our institution. And the strategy has basically three main pillars. The first one is trying to promote the disclosure of climate-related risk, that is information. The second objective has to do with the promotion of the integration of climate-related risk into the standard risk management of financial institutions, such as banks and insurance companies. And the final pillar has to do with the promotion of the development of the green financial market. Regarding this first pillar of our climate strategy, to promote the disclosure of climate-related risk, we made a very significant progress last year with the publication of the regulation called 461. Basically, what this regulation does is it revamped disclosure requirements for publicly traded firms, banks, insurance companies, asset managers, among others. And the regulation requires companies to disclose climate-related risk, following the lines of TCFD, the Task Force on Climate-Related Financial Disclosures. Moreover, the regulation also requires companies to disclose more generally sustainability metrics according to SASB, the Sustainability Accounting Standards Board. So it's more broad than climate. It's about the reporting of ESG issues. This is a very ambitious regulation, and it places Chile in the very frontier of corporate transparency around the world. We are very proud to be moving in this direction. And we have already also established a special unit dedicated to the oversight of the market compliance of this regulation. This is the unit that is headed by Gabriel Acuña. That's the first pillar. Regarding the second pillar of our climate strategy, well, the CMF has worked through the Climate Changing Working Group to integrate climate risks to the standard prudential supervision. And we have done this along two different lines. First, through the monitoring of risks. So we are developing the tools and capacities to identify, to assess, and to monitor climate risk using analytical tools like stress testing. The second line of work has to do with the assessment of our regulatory and our supervisory framework. So we have carefully studied our prudential framework to understand what kind of measures are needed to include climate risk analysis to our standard analysis. In addition, we are currently running several stress testing initiatives. Some of them are related to stress tests for insurance companies. We have a project with the IDB, the Inter-American Development Bank. And then we also have a couple of projects about stress tests in the banking sector. One with the IDB and Clapes UC, which is a Chilean university. And the other project is in conjunction with the IDB and the Volatility Center of New York University, NYU. Now, finally, I would like to talk a little about the CMF's plan to move forward regarding climate change. And the board of the CMF recently approved the Climate Strategic Initiative's second planification, which we label Phase 2. And Phase 2 will be executed in the period 2022-2023. It includes 5 objectives according to the priorities of the Commission, which are capacity building, prudential objective, market conduct objective, and both national and international cooperation. Let me talk briefly about each one of these objectives. In terms of capacity building, the idea is to implement a series of activities with the aim of strengthening the internal skills, abilities, and processes that the CMF requires to further advance in our climate initiative strategy. Let me give you a couple of examples. First, we're working on giving more internal dissemination of this document with the CMF's strategy to face climate change. This is to all our internal areas, the areas that do supervision and the areas that do regulations, the areas that oversight banks, the ones that oversight insurance, and also the securities market. Second, we have this conference, the first climate-related financial risks conference. We have learned very much from both the national and the international speakers about the role of supervision and regulation to address climate change issues. So that's another activity within this capacity building objective. Moreover, we are training our staff for the supervision of ESG disclosures, and we're talking directly with both SASB and TCFD. We are also training our staff on more analytical skills for stress testing in climate-related shocks, model development, and data collection. And finally, training the supervision and regulation teams more broadly by the climate changing work group on climate-related issues. That's the first objective, capacity. Then we have a second objective, which has to do with our prudential objective. It also has many activities. Let me give a couple of examples. We plan to send a mandatory survey of risks and opportunities associated with climate change to our regulated entities, such as banks and insurance companies. So these entities will have to answer this survey asking about different risks and opportunities related to climate risk. We also plan to publish a document on prudential supervision of climate risk. It's a manual. And the idea is to provide this manual to our staff who work on prudential issues so they can start integrating to their standard risk management supervision and to include climate risk to that type of supervision. We also want to provide a set of recommendations of prudential supervision practices to our supervision staff, always with the idea to introduce climate-related risk into our standard microprudential supervision methods. We also plan to provide a set of prudential regulatory rules, recommendations to our regulation staff to introduce climate-related risks into our prudential regulatory framework, such as, for example, Pillar 3 of Basel III, which we have talked today during the conference. And there's also some projects related to new, further understanding stress testing and the use of scenario analysis and data banks. This is an important and a continuous effort. That's the second objective, which is prudential. The third objective has to do with market conduct, integrity, transparency. And we plan to provide regulatory recommendations to address all these international developments on climate-related and sustainability-related disclosures under the ISSB of IFRS. So the IFRS is making a very valuable effort to harmonize different standards of sustainability disclosures. And we want to be at the frontier of that harmonization process. We also plan to issue a set of supervisory expectations for the disclosure of sustainability-related information to the market with our new regulation. The idea is to explain very clearly how the CMF expects our regulated firms to comply with the new norm. And we also plan to publish a market conduct supervision and of climate-related and sustainability-related risks manuals. That's the market conduct objective. And finally, we have a series of activities that relate both to national and international cooperation. So regarding national cooperation, we will continue to actively support the Ministry of Finance through the Climate Change Working Group in this Green Finance Roundtable. We want to enable and foster the creation of skills awareness among the participants of the financial market. We will also actively support the Ministry of Finance through the Climate Change Working Group in the development of the Chilean taxonomy of environmental sustainability economic activities, to define very clearly what is defined green or not, in the lines of what Colombia recently did. And we also plan to develop bilateral agreements with other state agencies that are relevant for sustainability topics, such as the superintendents of the environment or the superintendents of pensions. That's from the investment side, also with the Central Bank of Chile, among others. And in terms of international cooperation, we want to develop a stronger cooperation among regional members of the NGFS. We also want to take a more active role in climate change and sustainable finance in the Latin American Association of Insurance Supervisors. We plan to increase our collaboration with other banking supervisors of the region through the American Association of Banking Supervisors. And finally, to foster a regional alliance for sustainable finance oversight and capacity building on sustainable finance markets and products. So let me conclude with one slide. The CMF has clearly acknowledged how climate change can impact its objectives, and the CMF has taken clear action on this front. The CMF developed a strategy, creating a strategic initiative on climate change, and also creating the Climate Change Working Group. The board of the CMF approved recently the planning of the Climate Change Working Group Phase 2, which involves, as I just explained, significant activities in prudential, market conduct, market development matters. And finally, climate change represents a major challenge for both the Chilean and regional economies, and the CMF is giving a clear regulatory and supervisory response to this challenge. Thank you very much again for your time and for participating in this great conference.
Many thanks to Dr. Larraín, Deputy Chair of the Financial Market Commission of Chile, for his brilliant presentation that shows how challenging and ambitious the agenda of the Commission in this matter is. We have come to the end of our conference, and we hope that it has proven useful for all of you, and that these relevant matters that we have addressed will enrich our work facing climate-related risks. Many thanks again to our audience. Have a nice day. Goodbye.